All right, Trey, let's go ahead and get started. I'd like to welcome everyone to Fluent Financial's last webinar for 2025. Trey Talley is our head portfolio manager, and we'll be discussing events that are impacting our clients' portfolios. The first slide is a compliance slide. The information being presented today is myself and Fluent Financial and Trey. And Trey, why don't you kind of give an overview of what we're going to be talking about today?
Thanks, Mitch. Hello, everyone. So 2025 has definitely been a year to remember. It's come with a lot of volatility and a little bit of a wind shift here in markets. It's kept everyone guessing, and it's been a good year for active managers who could slice and dice through that. So this year, we came in and the AI trade was still kind of in full force. We knew tariffs were coming. We didn't really know what the magnitude was. Then Trump drops the bomb on Liberation Day, and tariffs were, quite a bit higher than most of the street had predicted. And we kind of had a nasty sell-off there in April. And we ended up recovering after Trump kind of capitulated on that and normalized trade policy. The market recovery has been quite strong off those April lows, but it was anything but. If you were kind of following along, a lot of uncertainty, a lot of back and forth. And so the year that, 2025 is kind of a year that was plagued with volatility and a lot of uncertainty around what monetary policy and fiscal policy was going to look like. And to some degree, we've gotten some resolution, but many of these themes are probably going to carry over into next year. But we're going to just quickly visit today and talk about what we see and what's happening in the economy, in the markets. We'll talk about what the Fed is trying to do to balance all of this uncertainty. And so with that, we'll jump in.
Yeah. And Trey, at this next slide is the leading economic index. The LEI has been trending downward for over a couple of years, and that's why we've been somewhat concerned and been more defensively postured this year. And the next couple of slides, let's talk a little bit about what this means for people.
Yeah, so that next slide there that shows the LEI, the leading economic index. It's important because it can weaken or strengthen before recessions or recoveries, respectively, and it tends to correlate pretty strongly with the market, and it can be a useful signal to kind of gauge the risks that are out there. And so what we're looking at here, this is kind of the 6-month rate of change of the LEI, and it's been negative really since 2022. We had a big bout of inflation coming out of COVID. The Fed raised rates to try to combat that and slow price pressures. And, really they've made some progress on that, but it really affected the cyclical sectors. So cyclical sectors, meaning, housing and manufacturing, trucking, and trade. And these things have really not recovered that well, despite rates coming down from their 5.5 handle there at the end of last year. Right now, we're kind of straddling the line, the self-imposed kind of arbitrary line of the recession signal that the conference board puts out there. And so it's yet to be seen whether this will spill over. Generally, in prior cycles, it does. The cyclical sectors are very sensitive to rates, and they can kind of be a harbinger of what's to come for the rest of the economy. And this cycle has been different in that services has been quite resilient. We've had a lot of spending come through from the AI wave that really started in 22 when OpenAI released their first AI model. And so that's kind of been what has, it's been very different. And so we've tried to balance that uncertainty with kind of defensive posturing at times. And we've been able to allocate when the risks make sense to risk assets. So the next slide kind of just shows, what is this, leading economic index, and just breaks it down. And stocks have been doing really well. Credit conditions, there's not a lot of stress out there. These are good things. These are the inputs that are help kind of keeping the index a balance here. The cyclical sectors, the consumer sentiment, those are still wrought with, a lot of revulsion from the inflationary wave that we saw. Rates are still kind of high. And so you're still seeing housing and manufacturing still kind of suffer from that. We think there'll be a small baton handing kind of between 25 and 26, where you'll actually probably see some of this invert, where things like, you may see some credit stress start to percolate just mildly. Stocks may wobble a little bit, but we think that, there's cyclical parts of the economy will be met with lower rates. The Fed should lower, rates 2 to 4 times next year. That's going to provide some much needed support there. So some of these industries that have been suffering for the past several years may actually get some aid coming their way in the next 12 months.
Yeah, Trey, now let's turn our attention to what the markets did for 2025 and how our portfolios performed. And what you'll notice, Trey, is the S&P. A lot of people look at that as the benchmark, was up about 15.7, Dow up about 14.5, and the Nasdaq up about 18.3. Our portfolio has really held up well, and I think it's a tribute to you and Ian by taking a kind of a risk-off approach. But when you did take risk, it really paid off well for our clients. And I think you guys have a really solid process that this is sustainable.
Right. So our job is to get our clients to and through retirement. We're not gunslingers. And so we want to balance the risks versus the rewards there. And so a little bit defensively postured coming into this year. We were a little worried about the economy and valuations. And even though it kind of was almost an exogenous shock there through the trade policy of the tariffs, markets did ultimately decline in April quite handsomely, like over down 20% for the S&P and almost 25% for the Nasdaq. But we even had that January wobble where DeepSeek comes out and, this is an AI model out of China and says, we've developed an AI model for a fraction of the cost and it's still pretty competitive. And that kind of rocked markets there early January. A number of the big AI players like NVIDIA and others were down, almost 20% in one day. And so it was a year of a lot of volatility. So coming in a little defensive, fared well. We have a lot of internal proprietary models that kind of help us gauge the risk and reward from a quantitative perspective. And a lot of those started to fire off in kind of the second week of April and say, hey, I think that this trade uncertainty has probably priced itself in, and it's probably a good time to start adding to risk assets. And so that's what we started doing through the balance of April, for the second to the fourth week of April, just getting allocated to some of the more higher beta names and, knowing that the market had priced in a lot of that uncertainty. And the next move was for the market to kind of climb that wall of worry. And it did. Most of the passive portfolios, even some of the actives, they have a blend of international. I think that's kind of a key theme over the next several years. But international stocks, we've kind of been overweight those, and those have really helped us out this year as well. Things like emerging markets up almost 30% this year. Almost twice the amount of the S&P 500. They're markets that most people have not had eyeballs on in a long time for good reason. They've underperformed. And I do believe we're at some sort of transition there between the two. But we're really proud of our active models. We have a few of them, like VNO being our kind of flagship active model, and it's up over 22% this year. And again, good international, some good risk-adjusted returns that we were able to pick up along the way. The stocks that we own, we feel very comfortable with. We can sleep through the night. They're not highly valued companies that do generate a lot of strong free cash flow. And so we have a good little portfolio that's been able to ride out the storm this year, produce some good results. It's a product of our process. We feel very confident that, next year will be next year, will be different than this year in thousands of ways. But our process, we feel like, is able to weather kind of multiple regimes and environments. And we're looking forward to closing out this year strongly and tackling next year and performing competitively.
Okay. Yeah. Thank you, Trey. Let's talk about interest rates and what the Fed's going to be doing with interest rates.
Right. So we got a rate cut a few weeks ago. And so that kind of resumes some of the rate cuts there. We're down to about 3.75% right now. The Fed is toiling with potential inflationary pressures from trade policy with an incrementally deteriorating labor market. And so they're very uncertain. So right now, the markets are pricing in about 2 more cuts for next year, which take us down to about 3.25% on the federal funds rate. That next cut wouldn't come until March. I think that we're going to take the over on that one. I do believe that the labor market is softening and inflation is not something to be particularly concerned about at this juncture. And I think that if we were to get something like 3 or 4 rate cuts next year, that would make a lot more sense. I think it will to you once we start looking at the data on the next slides.
Yeah. And speaking of inflation, Trey, I think what's really interesting when the information just came out recently, we're sitting at 2.7 now on inflation.
All right, so big surprise today. We got an inflation report. Market was looking for about 3%, came in about 2.7% there. Really, what has kind of stalled some of this progress on getting inflation back to target of 2% has been the uncertainty around trade policy. Tariffs have been, they've been very effective at kind of the president's agenda, but they're also raising prices in the core goods sector. So if you look kind of on the chart there, the purple bars, that's kind of just to illustrate the core goods components and the price pressures there. We've seen that go from negative last year to positive this year, somewhere between 20 and 30 basis points. That is kind of being buoyed by very strong forces of disinflation on the services side, largely driven by wages and housing. And so housing prices are, moderating, wage growth is contained. And so that is kind of muting some of the inflationary push from the core goods. This reading, we got a nice step down in the services, and core goods kind of flatlined. So the Fed is trying to look at it glass half full and say, maybe tariffs are a one-off price adjustment. It won't bleed over into the economy, and we can get this inflation, worry behind us that we've been battling for 4 years. I think that's the right move. But inflation is moving behind us. We look at kind of the market-based inflation expectations here. So traders use a number of different instruments. This one here, you're looking at just different inflation swaps. You're looking at 1 and 2 year time frames. So, the markets are trying to ascertain, what's the inflation over the next year and over the next 2 years. Obviously, as you can see, as we rolled into this year, inflation expectations were gradually rising. That kind of peaked there with the Liberation Day announcement. All the tariffs came out. China was at triple digit, tariff rates. It was not a great scenario. Since then, we've seen trade policy normalize. We've seen the markets adapt. And really coming into the third quarter, inflation expectations started to dive really steeply. So, from the market has gone from, seeing somewhere between, 3 to 3.5% inflation over the next year to now we're just sitting just above 2%. So at the end of next year, we could be very realistically sitting at an inflation rate year over year of just over 2%, which is the Fed's target. I think it's going to give them a lot of room to cut. What they should be more incrementally worried about is the labor market.
Yep.
Inflation is not a problem, but certainly the labor market is. What we're looking at here is we're looking at the unemployment rate in blue, and that's overlaid with the federal funds rate. And what we've seen is, the unemployment rate's rising. That's kind of first principles. We're up over 1%. We're up 1% over the prior year, and up over 1%, 1.5% since the bottom. And it's no coincidence that the Fed's cutting, and they should be. But the read is that if unemployment is rising, and kind of strongly so, what's to stop it? We're still sitting probably above the neutral rate. So the Fed is going to have to make a decision before too long to save the labor market. I think they'll do the right thing. They'll cut continuously, and that they can kind of maybe stave some of this off. But at 4.6%, I mean, we're not that far off from maybe triggering the SOM rule, which is another, economist tool to help kind of, assess when a recession is starting. But the labor market is weak. It's probably going to continue to do so. So we're going to get more rate cuts. Again, we alluded to, we think we'll probably get 4 next year, and it'll be because the labor market is forcing the Fed's hand.
Yeah, I think one thing that's important here, Trey, this is kind of a complex chart. You have years here on the x-axis. These pink or red bars represent recessions. And what happens is when unemployment spikes up, as it has, here's the dot-com recession, here's the Great Recession of 2008 and 2009, you're seeing this almost like a hockey stick with unemployment. We're starting to see that happen here. We may or may not have a recession, but we're seeing a trend that mimics the past.
Yeah, so, absolutely.
And I think what's interesting is I know with the big beautiful bill, there's going to be some fiscal stimulus that's going to add to debt. Why don't you talk a little bit about that?
Right. So as we turn the calendar, it's a good time to start talking about what lawmakers were working on during the summer. So the BBB bill, it's going to provide a measurable lift to GDP somewhere around 0.6 to 0.7% in the first 2 years. After that initial surge, the impact's going to settle in somewhere between 0.3 to 0.5%. It indicates that the stimulus fades, but it doesn't fully disappear. It's incremental growth. It's not regime changing acceleration. The the debt is going to rise, and it's going to rise probably more than we want. It's going to go from, the federal debt's going to go from 100% of GDP to probably 125% of GDP by 2034. So that's roughly, 8 to 10% higher. That's higher than the baseline path. And in other words, each year of modest growth comes with a permanent kind of step up in the debt. Debt is growing faster than growth in this instance. So, GDP gets a temporary boost, debt gets a structural increase. The bottom line is, this bill through the different, tax cuts, et cetera, they're going to buy growth today, but it's going to finance it by pulling it forward from tomorrow's balance sheet. That's kind of, the trade-off there that markets are balancing. But this is part of the key themes that they're going to run through 26, which is, you are getting some direct support, some fiscal impulse to the more cyclical sensitive sectors. And so this is going to impact, things like healthcare and manufacturing. And so you can start to see some of these companies that, are finally going to kind of get the wind behind their backs. GDP for them will be rising. That'll affect their corporate earnings. And so you can have somewhere to go. For the past few years, Mag 7 has been the only game in town. You'll find some companies that are able to tap into some of this growth and provide good returns for investors. So that's kind of what we should expect as we roll through next year.
Yeah. And next slide kind of talks a little bit about the Mag 7 and what's outside of it.
Right. So that top chart you're looking at there is just the difference between kind of the Mag 7 and the S&P 493. So big 7 companies, they're pushing a lot of money into the AI space, trying to all be titans. And then there's the other 493 companies in the S&P 500. And really, it's been dominant. The index has been top heavy for a long time. It's been concentrated. And so this blue line, when it's moving up, it means that companies outside of AI are actually starting to do better. They're returning just as much as these AI players are. So year to date, we're pretty much at a balanced return between the two. So the market has been more broad this year. Coming off that October wobble, last month we talked about, kind of some of the Hindenburg omens and some of the stuff that was out there. That since that October wobble, investors have not allocated to, their general Mag 7 names, the Magnificent 7 names like they have in the past. This dip came with a different wind change. And what we're seeing is a broadening market and investors starting to take shots at stocks that are not just betting on AI future. I think it's a key theme to watch as we roll through 2026. I do think it could have some legs there, and I think that there's some opportunities outside the Magnificent 7. There's certainly a lot of worry is what's going on in these AI players. They're spending most of, if not all of their free cash flow. Some of them are even borrowing debt. Players like Oracle and CoreWeave are getting caught up in that. They are getting pushback from the market. Insurance against their default has started to spike for these names. In some cases, some of these names have a coin flip chance of going bankrupt. So the market has, some worries there, and now it may have somewhere to go. And so that's a good thing. That is a positive thing. In terms of earnings growth and kind of where valuations sit, it's really hard to find anything that's undervalued. Some of the sectors that look okay or close to fair value are some of the defensive ones like staples and healthcare. Earnings growth is still dominated by these AI players, but you are having to pay up for them. And you can go outside of these AI players now and get some decent earnings growth with not as rich valuations. And incrementally, I think investors are going to start to steer that way.
Yeah.
So here, just a quick shot. Investor positioning. It's unfavorable. Positioning it's not a perfect tool. These things can extend and go to great magnitudes. But you've got the S&P overlaid there with kind of the individual investors' allocation towards stocks. And so what it's trying to show is, it takes bulls to make a bull market, but it goes so far to where it gets too good. And that's certainly the case here with this market that we have. Just like if you're in a boat and too many people get to one side, it can offset the weight and, risk capsizing. Markets are the same way. Most of the investors out there are allocated to the market. The incremental dollars are very scant. And so if everybody's kind of bought the market, really the next logical move is there's probably an incremental seller there available. So demand has maybe exhausted itself and supply is maybe more bountiful in the future. So this is just kind of a big picture look. Hey, there are some opportunities if for active investors like us, we pour through the data and we can we can hunt and peck and find those companies that, aren't richly valued and that have a good future. But big picture, the market is expensive and we should be aware of it because generally when it's this expensive and this owned, you get some sort of pullback or correction in the market. And going into a midterm year next year, I think that's important because typically you see some sort of wobble in midterm year. I don't think next year is probably going to be any different.
Yeah.
So the S&P 500, here we sit today. Where's it going? That's the million-dollar question. So right now, valuations, the PE ratio, it's kind of a metric of valuation. It's sitting around 22 forward for the market, and we're going to earn just over $300 a share for the S&P 500. So you can kind of take a look at some of the different scenarios if we apply multiples, and if we stay at this if we stay at these valuations at 22 times, we'll get some sort of flat market next year. If we get to tech bubble like valuations, which should be around 24 times earnings. That's about a 9% lift in the S&P 500 from here. So we'd have to tie the tech bubble to get there. Kind of absolute ultimate bull cases if you go and set new historical records there for valuations and you get to 26 times, you may have an 18% lift there in markets. We don't think that we're going to get an 18% lift in markets this year. Valuations are heavy and growth is a little uncertain, and investors are pushing back on so much of this money that's being spent. So, I think what investors should be preparing for next year is, a volatile year that comes with some ebb and flow, but a more normalized market. It doesn't mean that the sky is falling, but you should be prepared for a market that's maybe, flat to maybe plus or minus 5% next year with a bit of volatility. So if earnings grow, that can certainly benefit the picture there. But it's, as you can see, there's just the earnings yield on your investment today in the S&P 500 in many cases is below what you can buy for long-term treasury paper. You really need earnings to do a big lift here. It's a big ask for markets, and probably what's most healthy is just some digestion. And for we've had 3 years of really strong markets. Actually, in the bottom panel, you'll see that's that rate of change over the past 3 years. So we're up over 75% in a 3-year period. Very rare that we do that. When we do, it can go a little bit further, but it generally starts to take a breather. So investors just need to say, hey, it's been a good run for 3 years. Let's do the right thing and let's not be greedy and let's just be prepared and not lose our heads if we do see some volatility next year.
Yeah. And Trey, let's talk about 25 in review.
Yeah, so much stuff. You really can't even put it on one slide, but we tried. So 2025, again, we came in here with kind of a defensive risk posture, favored kind of some low beta stocks, high quality bonds, above average cash levels. And January, we got that scare there from the China's DeepSeek AI model, and that put markets on kind of razor's edge there. Going into February, we ended up creating a pretty major top there. In April, obviously, we saw the major sell-off triggered by the tariff policy. During that, we had cash available. We were able to, most of our clients were either flat or just nominally down during this period because we had so much cash and high quality stuff in the portfolio that most investors really didn't have much of a drawdown. And because we had dry powder and we were ready for that, we were able to allocate it to better risk levels. And so as everyone was panicking and thinking we were going into a global, depression, in April, we were buying stocks and doing the prudent thing. And markets came back and they climbed the wall of worry. The Fed started, lowering rates again. It's the first cut since September. And, of course, they did in December as well. And so this is kind of a year where, as you'll see, kind of the split there in the year-to-date returns from a lot of different indices. The winds have shifted a little bit. China was the top performing major MSCI index out there. Emerging markets, again, up almost 30%. All country world index is a good global market this year. The global stock market beat the domestic stock market. That's the first time in several years. So, commodities had a kind of a boring year. That was good stuff for inflation. Bonds had a good positive year. Credit spreads tightened, certainly. And so it was a very volatile year, a lot of happenings. And, and we kind of say, well, what's going to happen next year? That's the most important question. So when we look at the expectations, I love this little meme here. It's, he who lives by the crystal ball learns to eat a lot of glass. And I know that that's certainly the case for me. So what do we see when we look out to 2026? Your guess is as good as mine, but we think we have some expectations. And so what we've seen since October is a lot of worry around AI spending. Companies like Oracle have been, basically cut in half in 6 weeks. CoreWeave and a number of others have gotten caught up in that. Seems like NVIDIA just can't quite get a new high. There's a lot of concern around some of these names, not broadly, but some of these names, that there may be some sort of credit-driven risk in the future, that some of them cannot honor the debt that they are taking on, and that they won't be able to find the end users to generate the revenue off of the money that they're spending, the CapEx. We should just keep an eye on that. It's not an alarm bell or anything like that. But the credit risks that we are seeing, you just want to warrant close attention to those. Don't be a hero. Don't try to step into these companies yet. Wait for the smoke to clear, and then there'll be some great opportunities. And you don't have to. There's tons of good stocks out there. Tax cuts, rate cuts, and other fiscal support coming through, and it's going to hit as quickly as first quarter. So I think we're going to, the market's already started pricing that in. We talked about off that November bottom that just about a month ago. Really, it's been cyclical stocks that have been outperforming the broader market. So that's a theme that'll be around, I think, next year. Some concern around the Fed independence. Chair Powell's, he's going to get shown the door next year, kind of in the summer, and Trump's going to appoint a replacement. Investors are rightly so more, concerned that the Federal Reserve may be losing independence from, Congress or the presidency, and it's good to worry about that, but investors, I don't think, need to worry in this instance. That concern is likely to be overstated. You're likely going to see, a number of different dissenting opinions next year. It's going to be clear that the Fed needs to cut, so it's not going to be political. So I think that that's going to be something that can support lower yields and another good year for the bond market. Market leadership expected to broaden. It's already happened this year. We think that that's going to continue. We favor the S&P 493. So the big AI players, I think you can probably make better risk-adjusted money outside of them next year. And, growth probably underperforms some other factors. I think value can maybe do okay next year. International equity exposure is going to be key next year, I believe. Softening dollar and improving Eurozone and, Latin American economies. And they don't have that kind of concern of the AI overhang. Again, we've already said it once, can't say it enough. Next year, be okay if markets kind of normalize and they're plus or minus, 5% by year end. I do not forecast that we are going to have a very strong double-digit year next year. I do not think the valuations can support it. But that's okay. Markets, trees don't go to the sky, and markets need a breather, and that's perfectly healthy. So that shouldn't be concerning to anybody, but you should expect more normalized returns next year with a bit of volatility.
Yeah. This next slide is our stock of the month, UPS. And once you kind of tell the group, what you think of UPS, and then kind of give people an update on Dollar General. That was our stock of the month in November.
Yeah, so we pride ourselves on kind of being, good stock pickers and being balanced and finding companies that we can sleep well at night with good valuations and strong cash flow. And so this month we're kind of highlighting UPS, which is kind of in the midst of a better, not bigger. They're trying to improve margins, get some of the low margin business off their books. They're kind of in the midst of a turnaround there in kind of their core business, led by cost cutting. They've kind of transitioning away from some of the Amazon low margin delivery business that they had in that partnership. Overall savings have amounted to about $3.5 billion through the first 3 quarters of this year, with more to come. They are kind of leveraging AI for some of their logistics, and they're able to right size their labor force, which is helping them drive productivity and save on costs. It's good, it's a good company that's been beat up over the past 12 to 18 months. The valuations are attractive. Growth is returning to the stock. The technicals are improving. And so UPS is kind of one of those good old man stocks that's going to probably do well over the next year or so. And I think that's, kind of, again, the broader theme is there's going to be a lot of the boring companies that nobody's been talking about that start to shine next year. Most investors are not looking at them, but they're putting in good bases. They've right-sized their balance sheets, and growth is returning to them. And valuations in some cases are sitting at great financial crisis lows. So now you can lighten up on some of the concerns you have in the AI market and go find some good solid companies. Dollar General is one that we pitched last month. And I made the disclaimer kind of sheepishly that, Dollar General, it's not a sexy stock. I get it. It's not AI. Nobody's talking about it.
Go ahead.
I think that was one that we really cared about. And so that stock we pitched it around $100 a share, and it's sitting at over 135. So about a 35% gain since webinars last month. Not all of them are going to be great wins, and that's certainly not indicative of what UPS or others will do. We'll have winners and losers there. But that was one that, again, these companies that people aren't paying so much attention to, they have a great return profile. And if you can just spend some time like we do looking for them, they're out there, and they can make, this was 35% up while the market has really wobbled quite hard off of the past month or so. So that was something we're proud of.
Yeah. And as we kind of wrap up, this last slide shows 3 of our heavy option portfolios that our retired clients have money in. And it's one of the unique things about Fluent Financial. Our tagline is retire sooner with better lifestyle. The rule of thumb is you can't take out more than 4% of your portfolio without running the risk of outliving your money. We found a way that you can take out significantly more than 4%. And these are 3 of the portfolios. And this shows the targeted percent that we want to generate in cash flow. And on $1 million portfolio, this is what it would generate. This has actually been our trailing 12 months, what we've done. And we think these models are sustainable. It makes a big difference because oftentimes people are told if you want 100,000 at retirement, you need 2.5 million. You can have half that amount with the portfolios that we have, thus retire sooner, better lifestyle. So as we wrap up, we wish everyone a very Merry Christmas. And I'm going to stop the recording now and open this up for any questions.